The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. Welcome back, everybody, to Trajecta Talks. I'm your host, Alex Savanovic. In our previous episodes, we've dissected everything from the mechanics of sophisticated derivatives and the black box of private equity to the game-changing role of AI in finance. Today, however, we pivot to what many top traders argue is the single most important factor for long-term success, and that is the mental game. Today's episode is a deep dive into a book that fundamentally changed my approach to trading and investing. It's called Trading in the Zone by Mark Douglas. For me personally, this is a book I read and return to often whenever I need a reminder of its foundational teachings, concepts. There's a lot of good little adages in there. The focus on discipline, probability, things that are really important for this business. And now, this isn't just a book review, it's a breakdown of the psychological architecture that you need to build to consistently translate your analytical edge into tangible results. We'll explore why the desire for certainty is a trader's worst enemy, how to embrace probabilistic thinking, and what it truly means to think like a casino, so to speak. So, before we get to that, let's do the market update. The theme of the week is undoubtedly artificial intelligence, AI, as AI deals, chips, infrastructure dominated the headlines alongside a fresh round of earnings that painted a picture of resilient yet cautious financial sector. I thought this was a funny one. Walmart and OpenAI, in a move that signals the future of e-commerce, Walmart and OpenAI have announced a major partnership to integrate shopping directly into the chat platform. This isn't just like a simple search function. It represents sort of, I guess, the rise of agentic commerce, so to speak, or whatever they said. Customers and Sam's Club members will soon be able to shop Walmart through ChatGPT using a new instant checkout feature. Instead of the traditional search bar, typing in cereal, milk, eggs, a customer can simply converse with the AI, asking it to help, for example, help me plan a low carb dinner menu for the week or get everything ready for a 5-year-old's birthday party. The AI will build the entire themed shopping list, and the instant checkout feature will complete the transactions seamlessly. This fundamentally transforms online shopping from a structured task into an intuitive conversational experience with the goal of driving greater convenience and personalization. So the chip industry continues to be one of the most dynamic sectors. First, ASML, the crucial Dutch supplier of lithography systems, released its third quarter 2025 earnings today. Company reported net sales of 7.5 billion euros and net income of 2.1 billion euros, which was right in line with guidance. The bright spot was in the forward-looking indicators. Net bookings for the quarter remained strong at roughly just under 5.5 billion euros, and the company reaffirmed its forecast for a total net sales increase of around 15% for the full year 2025. CEO commentary noted continued positive momentum from AI-related investments, but also issued a cautious outlook, expecting sales to China in 2026 to decline significantly, compared to the strong business seen in 24 and 25. Meanwhile, a massive partnership announcement is heating up the AI compute race. So Advanced Micro Devices, AMD, and Oracle this time are significantly expanding their cloud collaboration. Oracle Cloud Infrastructure, or commonly referred to as OCI, is slated to become the first major hyperscaler to offer a publicly available AI supercluster powered by 50,000 AMD Instinct MI450 series GPUs, with deployment beginning in late 26. This move demonstrates the competitive pressure cloud providers and chip makers are placing on the AI infrastructure market, securing a large customer for AMD's cutting edge AI chips and positioning OCI as a formidable alternative in the quest for massive scale AI performance. So moving on to geopolitics, Trump's tariff threats spark a bit of a market sell-off. The optimism over AI and strong corporate earnings was quickly overshadowed last week by a dramatic re-escalation of US-China trade tensions, which triggered a broad sell-off on Friday, October 10th, 2025. That was last week. The market calm was shattered when President Donald Trump issued a new threat regarding tariffs on China. Now, remember, we haven't heard anything about tariffs in a while. It's been a few weeks. The move was in response to Beijing's implementation of sweeping export restrictions on rare earth minerals, which are critical components for the tech, electric vehicle, and defense industries, especially in America. So initially, President Trump posted on social media that he was considering a massive increase of tariffs on Chinese imports. After the markets closed on Friday, he formally announced an additional 100% tariff on all Chinese goods, which would bring the total tariff rate on Chinese imports to approximately 130%, just a little bit high. He also stated the US would impose export controls on any and all critical software. The threats and subsequent announcement triggered a sharp decline across major indices, marking the worst single-day performance in about 6 months. S&P 500 slid 2.7%, the Dow down 1.9, and the tech-heavy Nasdaq about 3.5. The market volatility also hit cryptocurrencies, with major assets seeing sharp drops and over $7 billion in positions liquidated in only a single hour. Investors sought out safe haven assets, causing US Treasury yields to fall and the price of gold to rise above $4,000 per ounce. Turning to the financial sector, the latest round of bank earnings from major US institutions like JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, I think Morgan Stanley came out just after this is recorded, so we might not get to that one. But they all showed resilience, strength. The headline theme is a general outperformance, with many of the big banks beating analyst expectations on both the top and bottom lines. Key drivers of the strength included strong capital markets activity, investment banking fees, and trading revenues saw a welcome pickup, suggesting a recovery in corporate deal making and robust client activity. A very resilient consumer. Credit conditions continue to trend favorably, with the consumer managing debt relatively well, even as loan growth remains steady. While the financial results were strong, the tone from management was one of calculated caution. I thought CEOs acknowledged the general resilience in the US economy, but reiterated concerns about the persistent risks from complex geopolitical conditions, trade uncertainty, prospect of sticky inflation. The message from that sector, I think, was pretty clear. The foundation is solid, but management remains prepared for a wide range of scenarios in a volatile global environment. So that's it for the market recap for this week. We'll be keeping an eye on how these tech partnerships, outlooks, there's tons of earnings coming. We just finished up Q3, so there's going to be so much to talk about in the upcoming episodes. Stay tuned for that. I love doing the market update. I know you guys love it too. So if you've ever had a brilliant market insight only to botch the execution, or if you've suffered from fear, greed, revenge trading, that is, this episode is your blueprint for achieving that coveted calm state of consistent performance. Let's dive into the psychology of successful trading. So the gap between analysis and execution, let's talk about it. Every trader begins their journey focused intensely on market analysis, mastering candlestick patterns, looking at indicators, the fundamentals, economic theory, and they correctly identify setups and trends. But when the moment comes to act, a psychological chasm opens up. They hesitate. They jump in too late. They move a stop loss just before it would have been hit, or they exit a winning trade prematurely only to watch it surge higher. So some of the things I just talked about, these are the central problems that Mark Douglas addresses. The profound gap between knowing what to do and actually doing it consistently. He makes the sort of radical claim that 95% of trading problems are psychological, not analytical. And if you read the book, you'll learn that that's not so radical at all. The root of this problem lies in the inherent conflict between the market's nature and the human mind's programming. So, the world that we grow up in teaches a cause and effect reality. If you work hard, you get rewarded. If you drive too fast, you get a ticket or you crash. Our brains are wired for certainty and consistent outcomes. You do one thing, you can be pretty certain that another is going to happen. The market, however, is a chaotic, probabilistic environment. And Mark Douglas describes it as a field of opportunities that is completely neutral, uncaring, and unpredictable in the short term. It doesn't follow our personal rules or logic. When a trader enters with the expectation of certainty and the market delivers an unexpected loss, the brain registers this as psychological pain. So, this emotional or psychological pain triggers defensive mechanisms, leading to classic self sabotaging behaviors. First one being hesitation or the fear of being wrong. The trader sees a perfect signal, but remembers the last time they lost money on that signal. They maybe hesitate, missing the move entirely. The brain prioritizes avoiding the pain of being wrong over the potential gain. Next one is revenge trading or the fear of losing money. So after a loss, the trader feels violated. They immediately jump back into a new trade without proper analysis, often doubling their size in a desperate emotional attempt to get back the money they lost from the market. And this always ends badly. You might get lucky, but if you do it again, it always ends badly. Next one's moving stops. The trade moves against them, and instead of accepting the predefined small loss, they move their stop further out, hoping the market will come back. This transforms a small, manageable risk into a potentially catastrophic loss, and who knows when it's going to come back. So, Douglas's central premise is that technical skills and brilliant analysis are only a small fraction of the equation. Mental skills are the vast majority. The solution is not to try harder or find a better indicator, but to achieve a state of mind where you internalize the probabilistic nature of trading. This means neutralizing your emotional responses so that the market's unpredictable behavior can no longer trigger the four psychological fears that plague all traders: the fear of being wrong, the fear of losing money, the fear of missing out, and the fear of leaving money on the table. So, until this mental consistency is established, your analytical edge will always be undercut by your own psychology. To overcome this psychological hurdle, Douglas insists that traders must internalize five fundamental truths. These truths are not technical rules, they are mental constructs designed to rewire your brain to function harmoniously with the market's random nature. So, truth number one is that anything can happen. This is the hardest truth to accept. At the moment you execute a trade, the probability of it moving in your favor, against your favor, or staying still is essentially 50-50 in that moment. It doesn't matter how beautiful your chart pattern is or how strong the earnings report was. The market is composed of millions of other human beings executing their own plans. The next tick is random. Accepting this frees you from the emotional burden of needing to be right on every single trade. It moves the focus from being right to managing the risk. Number two, you don't need to know what's going to happen next to make money. This truth establishes the concept of a trading edge. So, a casino doesn't know the outcome of the next hand of blackjack, never, unless they're cheating. But they know that over a vast number of hands, their small statistical edge, or otherwise known as the house advantage, guarantees them a profit in the long run. You, as a trader, need to find a sustainable edge, a pattern or system that wins more than 50% of the time, or wins enough when it's right to cover the losses when it's wrong. This is an expected value computation. This shifts your performance expectation from predicting the future to executing on an edge every single time without hesitation. Number three is there is a random distribution between wins and losses for any set of variables that define an edge. This is the key to consistency. If you execute your edge perfectly 20 times, you might win 12 times, lose 8, resulting in your expected 60% win rate. However, the wins might come in a pattern of loss, loss, win, loss, win, win, loss, loss, loss. The distribution is random. A trader who expects a perfect sequence will panic after 3 losses and abandon a perfectly valid strategy. Accepting random distribution means treating every single trade in the sample size as an independent, unbiased event. Truth number 4 is an edge is nothing more than an indication of a higher probability of one thing happening over another. So Mark Douglas forces us to define the edge mathematically. You are not buying a stock because it will go up. You are buying it because your model, your edge, shows that the probability of it going up is 65% versus 35% of it going down. Your job is to simply put yourself in the way of the 65% probability and manage the risk associated with the 35% probability. This rational detachment eliminates greed and fear because you are simply playing the odds, not placing an emotional bet. Every moment in the market is unique. This is a powerful counter to analysis paralysis. Even if the chart pattern looks identical to a trade you took yesterday, the underlying conditions, the news, the volume, the time of day, the global context are different. The market is constantly evolving. Therefore, you must resist the urge to project past pain or gain onto the current moment. Each trade is a clean slate with a unique potential for profit. So, by internalizing these truths, which by the way, I have written on a cue card and taped to the monitor, Douglas provides a blueprint for operationalizing a successful trading mindset. This is where the practical application of the book's philosophy takes shape, shifting the trader's identity from a hopeful gambler to a consistent, disciplined business owner. Mark Douglas argues that achieving the state of being a consistent winner requires fully integrating five core beliefs into your subconscious, beliefs that allow you to act without fear or emotional interference. This is arguably the most critical technical and mental step. Before entering any trade, you must know your absolute maximum loss, your physical stop loss. Once you have defined this monetary risk, you must psychologically accept that loss as the cost of doing business. This process solidifies two core beliefs of the consistent winner. So, core belief number one, anything can happen. By predefining your risk, you accept that the random outcome, a loss, is always possible but survivable. Core belief number two would be you take responsibility. You are responsible for protecting your capital, not the market. You must accept that the potential loss is a necessary investment to participate in a trade. If you cannot accept money as gone before you press the button, you have taken a position that is too large or you haven't truly accepted the randomness of the market. When the trade hits your stop, there should be no emotional reaction, only an immediate mechanical execution of the exit plan. This acceptance eliminates two major emotional traps: hope, holding on to a losing trade, and fear, taking profit early. Inconsistent traders focus on the P&L of the last trade. Consistent traders focus on the integrity of their process. Did you identify the edge correctly? Did you size the position appropriately? Did you execute your stop loss without hesitation? If you execute your plan perfectly, even if the trade results in a loss, you have performed successfully. Douglas encourages traders to literally keep a journal and give themselves a score on execution separate from the monetary outcome. Doesn't matter how much money you made on a trade, if it was pure luck or you did something in wrong, you need to recognize that. When your execution score is high, your long term monetary outcome will inevitably follow suit. This aligns with the third core belief, which is there's a random distribution between wins and losses for any set of variables. We talked about this earlier, that define an edge. By focusing on process, you allow the randomness to play out over a series of 10, 20, 30, hundreds of trades, trusting your statistics, not your feelings. Trading is not an external battle with the market, even though it can feel like that sometimes. It is an internal battle with your own psychological defenses. That's truly what it is. Self discipline is simply the process of consistently acting in a way that aligns with your long term goal of being a consistent and profitable trader. The goal isn't just to make money, it's to become the person who makes money consistently. That means cultivating a non emotional objective and a disciplined identity. An identity that does not need to be right, does not fear being wrong, and accepts every outcome as a piece of data, not a personal failure. This identity treats trading as a high stakes, probabilistic business, not an emotional roller coaster. It should never feel that way. This mindset embodies the final two core beliefs. So, core belief number four, I objectively identify my edges and act on them without reservation or hesitation. This means when your plan says buy, you buy, and when the plan says sell, you sell, regardless of recent history. Core belief number five is I completely accept the risk of my trades. This circles back to accepting losses as a cost, viewing them as inevitable occurrences in a random distribution, not as mistakes. So, by adopting these beliefs, The trader essentially removes the self sabotage switch. They operate from a neutral, objective state, allowing their statistical edge to work its magic. Trading in the Zone by Mark Douglas is not about finding the perfect indicator or the secret chat group. I know there's tons of them out there. Some of them you even need to pay for. It's about building the correct psychological framework to operate in a market defined by uncertainty. It teaches us to shift our focus from the impossible task of predicting the next moment to the highly controllable task of executing a proven edge with mechanical discipline. By embracing the five fundamental truths, defining and accepting risk up front, focusing relentlessly on your process, you can achieve that sought after state of mind, calm, objective, consistent performance. If you are struggling with emotional trading, this is the book to pick up next. It will challenge everything you know about success in the markets. And with that, we have to wrap up our episode. That's the end of the review on trading in the zone. I hope this breakdown helps you recognize and overcome your own mental hurdles in finance and in trading, investing, whatever it is you do in the markets. So, to stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, Facebook by searching for Trajecta University. That's TRAJECTA University. Also, check out our YouTube channel, Trajecta_talks, where you can watch this episode, find a ton of other great content. All the links are going to be in the show notes down below just for you. Join me next time as we continue our conversation about building your financial future. So until then, remember the market provides, but the mind decides. Keep learning, keep investing in yourself, and keep building your future. I hope you have a fantastic Friday. Take care. I'll see you next week.